Welcome back to the Global Business Report on Arise News. Let's talk Kenya. The government of Kenya has borrowed 6.4 billion shillings from the Korean government to finance a bus rapid transport BRT. The loan from the Korea Export and Import Bank will be serviced by taxpayers until 29th January 2061. The loan will attract an interest rate of 0.1% per annum and a service charge of 0.1% per annum. The government plans to launch 6 BRT corridors in Nairobi, seeking to improve the city's public transport network relative to conventional buses. Still in Kenya, the Kenyan Revenue Authority has said it will exercise caution before signing an inclusive international framework agreement to reform how multinational tech firms pay digital tax. This follows a recent announcement by the Organization for Economic Cooperation and Development, the OECD, that significant reform of the international tax system has been finalized to ensure that multinational enterprises are subjected to a minimum 15% tax rate from 2023. Kenya has been assigned a B+ rating from Augusto & Co. Limited, a Pan-African credit rating agency and a provider of industry research and knowledge in Nigeria and sub-Saharan Africa. This rating, according to Augusto, reflects its opinion on Kenya's elevated debt levels, contraction of the country's GDP in 2020, and an account of the COVID-19 pandemic, as well as the deterioration of the Kenyan shilling against major trade currencies. This in addition to the marginal rise in inflation and unemployment levels in the country. There were some upsides to the report, though. Churchill Ogutu, who's an economist at IC Asset Managers, joins us now from Kenya. Churchill, good afternoon to you. Thank you so much for joining us. Augusto & Co., they held a positive view on Kenya's agricultural sector. Has there been any full recovery from the locust invasion? How do you view the sector so far?
We've seen a rebound in the sector, and to be sure, last year, in as much as we had a contraction in the country in the order of negative 0.3%, agricultural sector had massive growth that was in the order of 4.8%. Speaking about the locust that was specific on that report, we've seen that impact being faded off. To the extent that even when the locust invaded some parts of the country, it was basically on the northern part of the country. It didn't go to the food basket regions. That's basically the middle part of the country. That's where usually we get all the food that goes to the wider part of the country. That was not impacted by the locust invasion. So that was the saving grace and led to the robustness in agriculture during the pandemic year that was there last year. So going forward, though, I still expect some risks in agriculture. One, looking at the rising global oil prices. Kenya is a net importer country. So basically, that means that we'll have a negative knock from the impact of global oil prices on the transport sector and ultimately disrupting the supply chains. And also, there's the erratic weather. Right now, the main concern facing this particular sector is the drought concern. So that might have a negative impact in the agriculture. But nonetheless, I still see it being resilient in the coming future.
Thank you so much. Still on agriculture, the recent tea auction sales, are they encouraging? How do you see how things have been going there as far as Kenyan tea exports and sales are concerned?
Yeah, it's encouraging. The headline number that we've seen so far is that the global prices of tea has gone up. So that's encouraging. Just to give you some flavor around tea, at some point up until 2018, it used to be the largest mechanized export item in Kenya in terms of earnings that you used to get. And then from 2019 onwards, you've seen that horticulture has now accepted as the #1 mechanized trade export good. So nonetheless, even last year, we saw the exports earnings from tea was around $1.3 billion. It's still decent compared to other products that we export. So based on the rising or the upward momentum that we're seeing in the global tea prices, that will catapult even the earnings, not only for this year, even next year if this trend carries on. So that's quite bullish metric that you are seeing concerning the tea commodity.
Good for you. That's $1.3 billion in tea exports. That is impressive. The ratings agency is forecasting a recovery in tourism and the hospitality sector for Kenya. How do you see that sector faring?
Well, I'd say it's still fragile. Last year, we saw the accommodation and food services, that's a proxy for tourism and also hospitality sector. It slumped 47.7%. That was not a surprise looking at the containment measures that were there, not only in Kenya, but across the globe. So that didn't even come as a surprise. And tourism arrivals, international tourism arrivals also plateaued 72% over the course of last year. Numbers that were there in 2019, 2 million visitors, came down to 580,000. So obviously, that didn't come as a surprise. Going forward, I still think that the certainty, the environment is still fragile. One, the low vaccination rates locally. I think we are around below 2% of the Kenyan population have been fully vaccinated. So that will put a dent even on some of the international tourists who want to come to visit Kenya just because of the environment that they're coming into. In as much as the developed world, we've seen high vaccination rates. On the flip side to that, I still see that the recent move by UK, at least to remove Kenya from its red list, that will be a significant boost to tourism, at least from the UK, where we've been receiving significant number of tourism from UK coming to Kenya. So that will give a shot in the arm, at least for some of the tourism sectors. But still, I think overall the sector is still fragile. It's yet to come out of the woods that you saw as a result of the pandemic.
Inflation averaged about 5.2% in 2020. Do you expect inflation to remain in single digits this year?
Yes, I still expect it to remain in single digits. So far, as at the end of September, it was 6.9%. And we've seen it's been basically a base effect story when you talk about inflation. Mainly in the second quarter and the third quarter, that's between the months of April all the way to September. And that's the base effect coming from the fact that last year, because of the pandemic and also the containment measures that were there, we saw that inflation trended downwards between April to September. So this time round, we've seen opposite effect. Now that's the base effect we're talking about. Now there's been an upward trend in inflation. But nonetheless, we're seeing that it's just picked up slightly upwards by 0.6% from April all the way to September, which is still decent in our view. So going forward, basically the final quarter of this year, expect that inflation will trend downwards based on what happened even last year. That's one. But looking at the sub-indices of inflation, what is sticking out as a sore thumb is now the fuel inflation, just based on the global oil prices. The last time I checked, it was around over $80 per barrel. So that's been an increase of northwards of 55% over the course of this year in terms of the oil prices. So that obviously will have a negative impact in fuel inflation, but nonetheless, it won't lead to upward spike in the headline inflation. So overall, I still expect it to remain at single digits in the course of this year.
Great stuff. Churchill Ogutu, economist with IC Asset Managers, thank you so much joining us there from Kenya to discuss the Kenyan economy. We appreciate your insights.